Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors, and welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and I am so thankful that you are back with us again today. It is always an honor and a pleasure to have you share your time with us. And today, I know you are going to be enlightened again as we talk about building financial freedom through manufactured housing investing. With us today is a man who has a deep and a wide wealth and fountain of knowledge and experience. Sharing his wisdom with us today is Sam Hales. He is a private equity real estate fund manager with over 300 million assets under management, and he is the founder of the Saratoga Group. Saratoga Group was established in 2011 and is exclusively focused on the purchase, revitalization, and operation of mobile home communities. Sam's previous real estate experience includes distressed asset workouts, land development, redevelopment, and lease options. Sam, take us into the show today and share with us a memorable experience that may have helped you to be who you are today.
Alan, thank you so much, and it's great to be here and have this conversation with you. As I reflected on that question, I grew up in Iowa, not to be confused with Idaho or Ohio, which often happens, but I grew up in Iowa, the one just east of Nebraska. And my dad was an orthopedic surgeon. A lot of the people that would come in to see him were farmers that had had some sort of farm injury. I can remember it was a summer when I was 14. A farmer came in and he had a hand injury and he needed some help on his farm. And my dad said, "Hey, I've got a 14-year-old son. He's looking for work this summer. He could come help you." And then my dad described to him how the previous summer I had worked on an alfalfa farm in Utah, and I had driven a combine there, and had some tractor experience, that sort of thing. And the farmer got kind of excited. He said, "Hey, for that kind of experience, I'd pay him $5 an hour," which was a good wage. I think minimum wage was $3.75 maybe. My dad then responded and said, "Well, he doesn't need that much. He'll do it for $3 an hour." And instead of actually driving a tractor that summer, I was shoveling hog manure for 10 to 12 hours a day.
Wow.
And that was a formative experience for me because I decided, number one, I never wanted to do manual labor when I had a chance, you know what I mean, professionally or whatever. But I think more importantly, just the importance, I think, that my dad was teaching me of hard work. And that's just been something that's been ingrained in me. And so, we call it grit or whatever, but anything that we do, we run across challenges and obstacles. And I've certainly had my share in building a real estate business, and just being able to have the grit and the determination to kind of work through it and get to the other side. So that was a formative experience for me.
Well, that's interesting. We shared a similar formative experience, as I've had experience on a hog farm as well, and have done my share of shoveling the manure. I was quite young at that time. I was a young adult, actually, and I was aware of the horrendous conditions in which particularly the sows, were being kept while they were pregnant, and then after they gave birth. But it wasn't sufficient enough awareness to really become an activist in doing something about it. But I think the conditions have even worsened for hogs in the industrial agricultural section, even worse than they were at that time. But for the audience that doesn't know it, they keep sows in it's almost a 2x6 cage, essentially, in their last few weeks of pregnancy, and then once they give birth, they keep them in that cage. and it's difficult for them to lie down and to get up, and they keep them there for several weeks. It's just horrible conditions that they do to sows. But anyway, let's get into real estate, and particularly mobile home investing. So why invest in manufactured housing?
I think that we're starting to see, and we're going to see to an even greater degree, a separation between the different types of commercial real estate because of, what's happened with interest rates and kind of economic conditions. The reason that I got into mobile home park investing, having done a whole bunch of other commercial real estate investment, was because I was looking for something that would be relatively recession resistant. And so the trouble that we've seen lately, certainly offices had a lot of trouble. Even multifamily, there's been, kind of precipitous drop in value there. We really are not seeing that in the manufactured housing. And I believe the number one reason for that is that it's very difficult to create new supply. So it's affordable housing. So you have just consistent, persistent demand for the product. And yet you can't develop new supply to kind of meet the economic, balance, so to speak. So there's always more demand than there is supply. And that makes it so that in good times and bad times, people need affordable housing. And that was something that I've spent most of my career in real estate in affordable housing well before mobile home parks. And the thing that particularly, like I said, attracted me to manufactured housing is just the ability to weather kind of any sort of economic conditions.
Yeah, that is one thing that I think is really compelling about this particular segment, is that I don't know of an urban community in the United States that isn't short on affordable housing. And yet there's very few, if any, who are providing for zoning for new developments there. And so it is a case where you have to get into an already established situation in order to be able to get into that segment. It's interesting, communities are looking for alternative housing opportunities, but right under their nose are, opportunities to allow for mobile home park development, and yet they don't do it.
That's right. Yeah, no, I wish, again, that's kind of a moat around the business, I guess you could say, but I wish they would, right? I mean, it's desperately needed. It would be fantastic if we could get more supply. I mean, it's the only sort of affordable housing that doesn't need to get supplemented by the government. You can do it just based on market economics. So, but unfortunately, like you said, nobody seems to want to embrace it. There's some rare exceptions, but for the most part, it's just not considered.
I suppose education would help with that, but I think it's going to be a long process. So I think the market is secure by the very things you pointed out here. Well, you have a vertically integrated plan. So first of all, tell us, what do you mean by vertical integration, and why it is that Saratoga has focused upon that?
Yeah, so first of all, let me define the vertical integration. Typically, when a investor or owner of real estate talks about vertical integration, it's probably referring to kind of self-managing their properties. And that's certainly part of what we have. So we've got about 120 employees at Saratoga Group. 2/3 of them approximately are in the field as either managing a community, maybe managing a district, or they're a maintenance lead for a community or portfolio of communities. And so that's certainly part of the vertical integration. But there's a couple other components that we have at Saratoga Group that really separate us from maybe other companies that are out there. Another thing is that we've developed our own technologies. So we use, whenever we can, we use industry standard or kind of off the shelf things such as Asana for project management. We use Google Suite services kind of team connectedness. And we use a product called Rent Manager for property management. But as far as something holistic that gives us kind of dashboards and KPIs that tell us how our business is doing, and we can drill down and figure out what's going on in a specific community or a specific district, we have developed those tools internally. So that's one part of, I think, our vertical integration that's unique. Another thing that we recently launched is we have our own construction company now. And that is not something that I had hoped to do, or it wasn't on my bucket list or anything like that. But we just found that as we just talked about how it's very difficult to get a new community entitled to go build it, but we get opportunities all the time to expand an existing community. So we might have on that same parcel or an adjacent parcel some open land, and it's much easier to go get that entitled to kind of add units. And so we've done that a number of times, but it becomes prohibitively expensive to hire in all these different markets, try to find a general contractor that isn't super busy, will give you a decent price, you know what I mean? Like all those sorts of things. And so we started cobbling together our own construction teams. And then January 1st, we launched our own company, and we're doing anything from full development to renovating maybe homes that are in existing communities, or just pouring concrete driveways. I mean, just a whole myriad of different things that allow us to move faster and definitely save money. So anyway, those are some of the things that we're doing that basically vertically integrate the company and help us to move faster.
Well, that's interesting. You have a full-fledged construction company at your fingertips, but you're outsourcing that to individuals and other companies. That's interesting.
Well, actually, let me clarify that a little bit. So the construction company has its own employees. So most of the work is being done by our W-2 employees. So it's not really outside people. It's our own employees.
But I meant you're outsourcing the services to other entities. Did I understand that correctly? It's not just you that the company works for.
Got it.
Yeah.
Actually, right now it is. So
is it? Okay.
That construction company has one customer, and that's Saratoga Group.
Okay.
Yeah. So as we grow it, we might offer it, outside, but we've got so much work with our own properties that we keep everybody very busy kind of doing that. Yeah.
Yeah. Okay. Well, it's still an interesting concept. I have spoken, I think, to one or two other individuals who actually have vertically integrated a construction company into their operations. And I mean, the reason for that is it's an entirely different skill set than asset management or property management. So I'm sure it was a challenge to get that set up and going. That's probably a story in and of itself.
It is.
But so you have built your company without institutional investors. That in itself is a feat, I'm sure. So how did you manage to develop a company of your size and magnitude without relying on institutional investors?
Yeah, and I should say we do have one portfolio that we purchased, and we did partner with larger institution on that purchase. Other than that, every asset in our portfolio is ourselves with investors that we've classified high net worth investors that might invest $50,000 to over $1 million, but not non-institutional capital. And that's very purpose driven. If we think about what we're doing, we're providing affordable housing. We're trying to expand the stock of affordable housing, and there's purpose behind that, and there's a mission behind that, and that's part of what we think about a lot at Saratoga Group. When you partner with institutional capital, you can lose your identity, you can lose your purpose very easily, because they've got their own agenda, they've got their own timelines and purposes and all the rest. And don't want to demean or demonize what they do, because I think it has a purpose. It's hard for that to correlate to what we're trying to do. We didn't want pressure to, have to drive up rental rates or all these different things. We have a very long-term approach, so we didn't want to have to sell after 5 years or 7 years or even 10 years. And so we felt like raising capital from individual investors, giving them an opportunity to have liquidation events, but with a whole intention that would be us buying them out, and we would continue to own those assets over time. That's what we were striving for, and that's why we really have avoided institutional capital.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Yeah, just if nothing wrong with them, just different purposes, different values,
right.
And yes, I can see how they could have major impacts upon your intended operations there, just because of the amount of their capital that would come into a particular deal. Well, what sets Saratoga apart from other manufacturing housing operations?
I think we probably covered a big chunk of that as far as the vertical integration. I mean, having our own construction company, we just bought what's called in the industry a toter, which is a truck that will move homes. See, in our business, we buy communities all the time that are half occupied or 60% occupied, and you look at that and you say, well, there must be a problem. Like, if I bought a multifamily building that was half occupied, I'd think, like, does this thing need to be torn down? Like, why does nobody live here? In manufactured housing, the reason is you have to bring the homes in, get them set up, make them move in ready before people aren't normally just going to pull a home in and put it on a lot in your community. So anyway, that's like I said, I think the main thing is we're just thinking through, okay, what are all the obstacles to infilling, to which creates value for these communities, and how do we kind of go tackle those problems in a more efficient and more accelerated way. And I would say, it's taken us a while to figure this out. I mean, we didn't start out thinking, hey, we need to vertically integrate all this stuff, and so we've gotten stuck in the past as we try to get that momentum, and it's hard. The hardest thing about our industry is infilling a community, is bringing in those new homes. It's like getting the financing to do it, the capital that's required, the work and the expertise as far as, with each different state or municipality and what the requirements are to get the water turned on or the sewer turned on or the electrical turned on. There's a lot of kind of nuance to all of that. So that's one thing I've noticed, I think, relative to other owners or investors in manufactured housing. We're very willing to kind of dig into a difficult property that has lots of vacancy or has other issues and kind of solve those problems. We have a pretty clear idea of like what things can look like on the other end, because we've done it quite a few times. So I'd say that's probably a main difference. And I think that creates opportunity for us, because there's a lot of interest in this space now. And so, but there's not a whole lot of interest in communities where the roads all need to be repaved and new homes need to be brought in, all the work. Not as many people or as many groups are interested in that kind of effort.
Well, I think there's a lot of intimidation in conjunction with that, because a lot of the mobile homes are not on sewer and they're on septic systems, and there's, fear of failure of that. And then how do you repair that? How do you put in a new system? Extraordinarily costly endeavors. Another aspect of mobile home parks are they on city or municipal water, or are they on a private system, which brings in a whole lot of new headaches. And I know all about this stuff. You've been doing it forever and ever, but to people who aren't familiar with it, those are really quite intimidating aspects, because not only does it take, particularly with private water systems, there's a whole process of certification and expertise that has to go behind that. And then, of course, there's also the aspect of what happens when that well goes dry or things like that. So it's an intimidating process for people who are not familiar with it. And intimidating because of the possibilities of failure, but intimidating because of the possibilities of all of those things run
Right.
into expense. That can be enormous expenses there. And so it isn't a segment that is for the faint of heart or the inexperienced. You could easily lose your shirt in this business. But I
Sure.
also know, on the other hand, the reason that you're in it and many others are in it is because the returns can be quite astronomical compared to other segments of the industry as well. So, risk as opposed to opportunity is always the question there. Well, Sam, tell us about the Saratoga Group and what you offer to our investors, and how can we get in touch with you to be part of that?
Yeah, you bet, Alan. So Saratoga Group, up to this point, we have purchased 105 communities. Well, I guess it's 106. We sold one. We normally don't sell, but anyway, and it's around 7,000 units that we have, and we have over 400 investors. So anyway, that's just kind of the background on us, and we regularly are, I mean, buying or acquiring new communities. We've probably averaged buying over 1,000 units a year for the past six years or so, which obviously leads us to the 7,000 units that we have today. That's slowed down a little bit recently. It's, financing is much more difficult, and I think I mentioned earlier on, like, we haven't seen much of a value drop in communities, and I guess that's good and bad. But the bad part of it is just, if rates are higher and values haven't gone down, it's like, it's hard to make the numbers work. And so we haven't done as much over the last 12 months or so. But anyway, that being said, we believe that there's going to be some more opportunity coming in the next 12 to 18 months, and potentially some distress. We're seeing a little bit of that. And so we're kind of preparing ourselves to be able to acquire some more communities here in the near future. So anyway, as far as getting a hold of us, I mean, I'm on LinkedIn, but our website is saratogagroup.com, and there you can see examples of some of the different projects that we've done, some of the development, some of the, redoing sewer lines in a huge park in Radcliffe, Kentucky. I mean, just a number of different things that we've done there, and always open and happy to talk to anybody about kind of what the company is about, what we're doing, and sharing, opportunities to invest as they come up in the future.
And all of that information will be in the show notes. Sam, one last question. What was one of your most difficult setbacks, and how'd you come through that, and what was the lesson learned from that?
We joke all the time, like, we're going to write a book. It's not just me. I mean, I think everybody in this space kind of probably feels the same way. Just some of the things that happen, you're like, I can't believe we're talking about this. I can't believe this just happened in our community. And so we've had some things, anywhere from the funny to the tragic. But I think, maybe this goes to the genesis of our construction company, but let me just kind of tell you how that started. So we had this large, and we still have it, a large community in Radcliffe, Kentucky, just south of Louisville, 311 pads. We knew that there was some issues with the sewer when we bought it. It was bought as a portfolio, and we had, certainly allocated some money in the pro forma to fix what we thought it was. As we started owning and operating the community, we figured out we had a much bigger problem than we had anticipated. And so anyway, as we literally and figuratively dug in on the sewer problems and started to understand the magnitude of the problem that we had, we took that, we went out to bid, and we got some bids back that were so far beyond the pro forma. We're talking millions of dollars. I'm actually trying to remember the numbers right now, but I think we were in the range of 1.7 to like $2.5 million to redo and that sounds like, crazy amount of money, but we're talking about redoing sewer lines that are, 10 to 13 feet underground. There's a lot that goes into that. It wasn't all that deep, but in certain portions because of grade and fall and all the rest of it. In the meantime, we had somebody actually that here in Knoxville that I had gotten to know, a contractor, and he'd done some work for me at my house, and very talented guy as I got to know him and find out that, wow, he built mobile home parks. He had developed, all sorts of different septic and sewer systems. I described my problem to him, and we decided to just take a chance, send him up there with a small crew. We'd rent the equipment and just kind of time and materials. Let's see what we could do this job for. So it turned out that something that was going to cost us over $2 million, he got done for less than $200,000. And that's when we knew, okay, this is an opportunity. We can probably replicate this in other places where we have large capital expenditures or projects that we need to get done, and try to get them done for significantly less than we can go to market and get them done for. So I can tell you it was a very stressful kind of experience to figure out, well, we've got a really big problem here and we don't have the money allocated to solve it, but people can't have sewer breaks bubbling up in their yards. Like, this needs to get fixed. And then being able to kind of work through that, come to a solution that not only solved that problem, but really kind of set us up to be able to do some of the fun things we're doing today in terms of developing new communities and that sort of thing.
Well, interesting how a misfortune, what could have been a real setback, actually turned into an opportunity. That's always a nice ending to a story. So
yeah, they don't all work out like that, right, Alan?
this
it's
is
nice.
true.
It's nice when they do.
It is.
Yeah.
It's very nice when they do. Sam, it's been wonderful having you with us today. Thanks for sharing your expertise and knowledge with us. And enlightened investors, thank you so much for being with us again today. Please take a moment to like, share, and subscribe. And if you would, please leave us a rating and a review. Until next time, live abundantly. We'll see you in the next episode. Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.